Welcome back. Bill Griffith along with Courtney Reagan in for Larry tonight. Now, if you thought this was a big week that we just finished on Wall Street, next week could be even bigger. And here are just three of the major items investors need to be looking for. First, on Sunday night, we get a crucial report on China's growth, the GDP number, among other things. Later in the week, we have Ben Bernanke's testimony on Capitol Hill. Here we go again. And, of course, throughout the week, earnings season really kicks into high gear. So here's the question. What's the most important thing to look for next week? Let's ask Kate Warren, investment strategist at Edward Jones, and Lee Munson, chief investment officer in Portfolio LLC and the author of Rigged Money. Good to see you both. Thanks for joining us tonight. Kate, what's your answer? A lot of traders I was talking to on the floor of the New York Stock Exchange today were kind of squaring up their books, getting ready for that GDP number from China on Sunday night. What's the big one for you?
I would say the China number is less important than the overall aspect of earnings. It's a key week for earnings, lots of companies reporting, and it's really hard not to say that Ben Bernanke's testimony won't be one of the drivers, at least on Wednesday and Thursday. But I think overall it's the earnings picture that'll really be the driver of stocks, and that's because people are still watching to see are companies able to deliver their earnings in this slow overall sales growth environment.
And Lee, how about you? How are you positioning your clients as you look forward to this really big week that we're going to have in light of what Ben Bernanke may or may not say, the China data, and all the other things that we need to be watching carefully?
We think this is a time to be adding equities to portfolios.
Kate, I'm sorry, this was for Lee.
Oh, I'm sorry.
Go ahead.
That's good. You know, what we're doing right now, I did a ton of bond trading today. We're very concerned about the duration or how long our bonds are. So what we don't want viewers out there to do, Bill or Courtney, is to dump their allocation to bonds. What we want to do is we want to narrow it so we don't have a lot of long bonds, because honestly, my crystal ball hasn't worked since 2000, and we don't know how that's going to affect. So what we want to do is lower how many calories we spend on our bond risk, and then we want to spend all of our calories on stock, especially in China, especially in the emerging markets, because they've been hit hard this year. And then earnings, I'm not too concerned. The American economy, the international economy, they're still rolling. So again, just reduce the amount of calories you spend on your bond risk, and then jack it up. It's like having a salad, guys.
Right.
Don't put so much blue cheese on it. Get a bigger steak.
You feel like the long rates are going to continue going higher, obviously.
Well, I think it's clearly if they do, because, you know, overall long term, you do better buying longer bonds than short term bonds. But I think here going forward, you have to make a decision. If we're going to get the growth that we think, long rates will go up. So you don't have to decide. But for my clientele who's retired, if we have a 2 or 3 year recession in the stock market, they've got to have a bucket that they can source money from.
Right.
So I'm willing to give up some returns on the bond side going long so that people have money to live off of. It's a very, very important lesson.
Kate, come on, let's be real. Ben Bernanke is more important than earnings reports, isn't it? I mean, haven't we learned that by now, that the reason that the stock market keeps going up is because Ben Bernanke keeps buying up bonds, treasury bonds, and mortgage-backed securities? Isn't that why we're really talking more about him than we do earnings these days?
Well, I think day to day, what Ben Bernanke says and what he's doing matters more. I think over time, the earnings matter more. And the reason is, if the earnings weren't coming in at least at expectations or a little better, which they've been doing for the last few years, I think the market would be much more focused on the earnings problem and much less focused on when the Fed may stop buying bonds each month. So I think overall, the reason that we're focused on the Fed is that earnings have been okay and nobody has to pay a lot of attention to them. If that changed, then I think the focus would really shift back to earnings very quickly.
Lee, I'm wondering how fragile you think the economy is right now. Can we handle 3% on the 10-year, 5-6% on the 30-year mortgage rate for most Americans?
You know, I think we can. I think 3% doesn't bother me. It's when we get to that 4 and a quarter, that's when I'm going to start having to really do some soul searching and looking at our bond allocation. But remember, a lot of people were concerned about those higher rates affecting the housing market, but it's all in the context of higher expected future growth. Mm-hmm. So in that sense, if you're concerned about those higher rates, then you definitely should be focused on earnings. What I think people should be doing is focusing on neither getting the higher higher risk in the stocks, which means going for the value, going for smaller, and trying not to go to the cocktail party tonight where you're going to be talking about rates. Go to the cocktail party where we could be talking about how we're adding to our small, adding to our value, getting in there and buying some stocks.
If you're going to a cocktail party to talk Fed policy, I'm not going to that cocktail party. Thank you both for joining us tonight. Appreciate it very much. Kate Warren and Lee Munson. Courtney, a delight having you with me tonight.
It was great to be here with you
tonight. Enjoyed it very much.